It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Well, it is April, and it's time for our analyst roundtable. And there's not been a lot going on lately, so I don't know what we're really going to talk about today. So we're going to kick off the month with Glenn Dorsey, one of my favorites. He's the head of client portfolio management at Clark Capital Management Group. It's been a busy quarter. There's been some interesting issues, not just the war, that's the obvious one, but we're going to go back and talk a little bit about what we talked about in January in terms of market volatility. And Glenn, this has happened a couple of times where we've had anticipated market volatility, but the reason for it was not what we expected. So first of all, Glenn, welcome. Glad to have you back.
Well, thank you, Leo. Pleasure to be on.
But before we get started, and we talked about this before the show, that Glenn has become such a popular guy that he has his own bobblehead. It's true, he really does. Had I had room in my suitcase that from the gold form, I would have snagged one and brought it back, and I wish I would have did that. So it's pretty cool. It's a great piece. So I love that he's an intelligent individual, but this just goes to prove that he just doesn't take himself that seriously, which keeps him grounded in what he does, right? So again, welcome, Glenn. So thank you. In January, we talked about that the fundamentals were still strong, and that we were anticipating an up year. And one of your predictions was you were expecting a lot of bumps in the road, significant volatility. And that's what your tea leaves were telling you. And then, boom, the war came, and that sort of changed the landscape in terms of volatility, right? So it's not like it's a surprise volatility, but the reason for it maybe is.
Yeah, we had cited midterm election years. You typically get some volatility, and in fact, it's generally the second quarter is the weakest in a midterm election year. And we have new Fed chair, hopefully starting in the middle of May, and those were two items that we thought could create some volatility. We obviously were coming off of a strong year last year, and then the 2 years prior to that as well. So we had valuations that were on the full side, if you will, not very problematic, but when they reach those levels, the market's unforgiving, right? So if anything goes wrong, you're going to have a larger reaction. We did not anticipate, the situation in Iran that obviously came out of the blue for us and for the markets. And whenever you get a shock like that, you're going to have pretty rapid reactions. The stock market, by and large, has held up pretty well, all things considered. We got to 9.1% off the January 27th high. A 10% correction is normal in an average year. So given the circumstances there, and with oil spiking from the 60s to over 100, it's a pretty rational reaction. And I think, in our opinion, as things hopefully settle down there, asset prices will revert back to where they were. Maybe not as quickly as they went up, but probably pretty quickly. So
let me shift a little bit, but on what you're talking about here, let's talk a little bit about the geopolitics, the war in Iran. And, this is on the heels of Venezuela, where there's regime change, where there's more of a grab for the oil or the control of where the oil is flowing, which is affecting not just us, but it's affecting Europe, affecting a lot of poor countries as well, which those end up, in many cases, could be the emerging market companies in those parts of people's portfolio. So this war, conflict, whatever it's being called, spills over into the geopolitical world. And with any war, especially this past week when President Trump spoke, when he said they're going to finish the job, the markets, at least the next day, started out with a negative reaction to that, because the bigger risk of not just taking control of the Strait of Hormuz from the geopolitical perspective, but just the continued disruption of the flow of oil and putting pressure on and adding the word recession back into the conversation, which I've been hearing more lately. I don't know if I believe that. I believe maybe more of a deceleration because of the higher prices of oil. But there's so much more down the road that is yet to be sort of predicted because of where this goes. Because the other thing, too, is if the bombing continues the way it's threatened, at least, then that's more destruction to the oil infrastructure, which even if they signed a truce in a week, that could be years to build back up. Where do you see all that playing out?
Well, there's a lot to unpack there. So,
Sorry, I tend to
if you look
ramble
at
my thoughts.
no, that was great. If you look at the big picture, we're about 100 million barrels a day, a little bit over that in terms of consumption. About 20% of that comes through the Strait of Hormuz. Most of that is going to Asia, right? China, Japan, North Korea, Thailand, India are the big recipients of that. The U.S. essentially gets nothing from there. We get about 6%, but quite frankly, we don't need it. So it is somewhat regionalized. China has 100 billion barrel strategic petroleum reserve, so they're not going to be as impacted. Japan's probably one of the countries, and maybe India, that are impacted the most. To your point, the damage that could be done to the infrastructure could be more lasting. Now, there's a lot of different equations that we look at. So every $10 increase in the barrel of oil is about 0.1% off of GDP, right? So we're $40 a barrel roughly up. So, that's less than 0.5% off of GDP. And if you think back to 2022, the great recession that we were going to have that never showed up, gasoline was $5 a barrel, or a gallon rather, right? And we're roughly 4 right now. So the pain point is typically right around $5 a gallon in gas. So we're not there, and I don't know that we're going to get there anytime real soon. The U.S. is the largest producer of oil in the world by a long shot, almost by a factor of 2 versus the other next closest country. So, I think we're able to maintain the lower prices, and you can look at the differential between West Texas Intermediate crude and Brent crude, right? And that's reflecting some of the supply transportation issue. It's really a transportation issue more than anything else, not a production issue at this moment. So, the average family uses about 20 gallons of gasoline a week. So we're paying about $1 more a gallon. So $20 a week, $80 a month. If you're on the lower quintile of income earners, that hurts, right? But we've had this K-shaped recovery for a while, and it's not the lower quintile of income earners that are driving the economy right now. It's those above that. So again, it's that from a just a pure number standpoint, forgetting about the human aspect of what's going on there, and also for those folks that are really impacted financially from this, it doesn't appear to us that this is enough to push us into a recession or even really that close to it. So hopefully I answered your multi-part question with as many multi-part answers.
Yes, you did. Well done as well. So so this is more of a headline risk, would you say, at this point, than it really is a practical risk? Is that a fair way to sum up what we're both saying?
I think that's fair, right? So there's a lot of oil that's floating around right now in ships. There is a lot of releases from strategic petroleum reserves around the world. It's not really that we don't have the oil; it's that we're not able to get it where we need it to go, right? And so I do think it's more of a headline risk right now than an actual risk.
So let's talk about maybe a K-shape recovery in the opposite way in terms of the price of oil. With all this oil floating around, let's say in 2 weeks there's some sort of a truce and the transportation issue gets solved. Are we in a situation of a glut?
We were oversupplied with energy before this happened, and you had seen crude prices drifting down. So we were, globally producing more oil than we needed, And our base case for energy prices prior to the Iran situation was that crude would continue to drift down, and so would gasoline prices. So I don't think it's unreasonable that that would come to pass. Now, again, it's not like flicking a switch and all of these things are miraculously resolved. It might take a little bit of time, but I do think we go back into an oversupply situation.
So, that being said, Glenn, what's the end game of the conflict with Iran? Because if oil was already drifting lower, and if you had so many of these countries whose budgets are built on the price of oil and that's drifting lower, they're already in their own economic trouble because of the oversupply scenario. And since there's so many producers of oil these days versus in the 70s when the Saudi Arabians sort of controlled the world distribution of oil, right? So that they no longer have, like OPEC doesn't matter nearly like it used to, right? So
Right.
if that's already happening, they're already feeling their own economic strain. What was the end game to do this, in your opinion?
From the U.S. vantage point of doing this?
Yes.
Well, it's sort of hard to unpack all of the information with that as well. But I do think it was centered around potentially nuclear capabilities in Iran. I think that was the primary objective. We had we had done the bombing earlier, which set back their uranium enrichment program. But I think it was determined that that was not enough. If you look through, there's some other potential aspects, right? And you mentioned it. We have Venezuela that we now have control. Venezuela is only about 1 million barrels a day in terms of production. At their peak, however, before they didn't reinvest in their equipment, they were more like 4 million barrels a day. But still, in the grand scheme of things, that's relatively small. I'm talking about like 4% of production. Iran, much bigger. And Iran is also a major supplier of drones to Russia. So I think, there could be the ulterior motive, and this is kind of just thinking through what possibilities there might be, more control of the energy globally by the U.S. and shutting off a major supplier of drones to Russia and maybe that brings them to the table to help get a resolution of Russia-Ukraine. So that could be a possibility. And I think, even in the region, as we've seen, Saudi Arabia, UAE are not huge fans of Iran. So I think that it may, in some ways, strengthen our relationship with the other Middle Eastern countries as well.
So let's go back to world economies. I also think part of the play here too is to disrupt the China grip, the international China grip. Since the negotiations with China have become much more difficult because of their rise in their power, that's how I looked at the Venezuelan situation and now here, so that if we have more control over the supply of oil, there's more reason for them to negotiate with us in terms of trade.
I don't think it's a coincidence that President Trump postponed his visit to China with Xi. So until May, I think he wants resolution in Iran, and I do think that gives us a stronger bargaining position than before. So I would agree.
Okay, so we talked about the practical impact of the increased price of oil, and if it's temporary, do you see that in this quarter? And that's a great point. Let me just a couple of things. That's a great point of saying where we were in terms of stock market pricing, and that's one of the things we spoke about in January. Things were kind of priced to perfection, and then when you get priced to perfection, it gets really hard to keep earning perfect. So company earnings, if they meet expectations, that's no longer perfect. That's the expectation, and we've seen company stocks go down this past quarter by just meeting expectation, which from where I sit, it's a bit of a relief because that means there's rationality still in the market and starting to put pressure on stocks to be priced to where they really should be, not necessarily at perfection. I think the war, like you said, accelerated that with the relative down 9% price corrections and getting back to a normalized 10% correction. From where we sit going forward, that's sound, But that being said, do you think there's any underlying economic damage that we haven't seen yet?
It's certainly not showing up in earnings, Al. We're the first quarter earnings are going to start to come out. But what's been interesting is typically when you get to the few weeks before the end of a quarter, you will generally see analyst estimates go down. Right? They lower the bar a little bit. The companies report 75 to 80% of the companies will beat estimates, and the world is good. What we've seen right now is that estimates have been coming up for 2026. We went at the end of February. We were looking for $315.36. That number's come up to about $323 in just a month. It's gone up by about $8 a share. 2027, where it was about a $365 estimate, that's now $377. That's gone up by $12 in just the last month. So it's been a departure from the normal pattern, which to us indicates that the companies are guiding the analysts that they're going to have another strong quarter. And keep in mind that most of what happened in Iran probably didn't have time to filter through earnings yet. So, I think it's going to be another really good quarter when you have earnings increasing mid-teens for the next couple of years. You can have pullbacks. You can even have corrections in the market, but bear with increasing earnings, right? And that usually you see earnings falling apart, and that will really drive stock prices down. This has been the opposite. You've seen stock prices come down. And in some cases, in some of the tech land, you've seen 20, 30% pullbacks in stock at the same time that earnings are going up. And I listened to another research vendor that we have. He said that's never happened in the 30 plus years that he's been tracking this stuff, where you have stock prices come down and earning estimates go up. It's usually the other way around. And they call that, an alligator jaw, where earnings are dropping and prices are still going up. And this is a big chasm between the value of the business and where the stock price is trading. This is the opposite. And, it should theoretically resolve by hopefully the stock price is going back to reflect the true value of the business. You go back a year, everything was AI, the darling of the market. And then all of a sudden, a couple of reports come out, and there's concern of overbuilding. And if you look at the Magnificent Seven stocks, and seen out Tesla, which has its own multiple, they are trading cheaper than the consumer staple stocks right now. And obviously, when you look at growth, there's a good chance that Techland is growing faster than toothpaste or deodorant, right?
Yeah, right.
So it's a little bit out of sorts. That's probably the highest growth area. It's not probably, it is that right now the highest growth area in terms of an earnings expectations and earnings that have been delivered, to be trading cheaper than areas that are much slower growing and typically really defensive.
And that's a new conversation that we haven't had in a decade. How inexpensive tech stocks have become because of that.
Yeah, I won't name names, but there's a memory company that's trading at just above 4 times forward earnings.
Wow.
Yeah, 4 times is it's traded there before, but it's always been at troughs in the market, like a 2018 after the big correction, the fourth quarter of 2018. So it seems that those types of companies that do actually have pretty strong fundamentals and growth have really been punished. And hopefully that could become the leadership ones again as the market starts to right itself.
Yeah, and that's a great point, because right now, as you know, since July of last year, the software stocks, which many of the Magnificent Seven are, have not performed well at all, because the word on the street is AI is going to render their products not as valuable as they used to be. Even though they're massively diversified companies, multiple revenue streams, and other revenue streams outside of software aren't going away anytime soon. And looking at even their software, even the large companies are starting to come out and saying, "Look, we're not going to rewrite software. Our enterprises are too big to try to replace this. It's nonsensical to them." Now, I think it's called Vibe Software. Is that right, or Vibe Computing? Am I saying that right?
Yeah. Yes.
Where they're trying to just use it to customize what they do a little bit. But that's more like a software helper, not a software replacement, right? So
I think that's exactly right. Yeah.
do you think that that's an oversold scenario?
I heard someone on I think it was on the radio, and they were talking. It was a programming company, and he said we've been using this for years, AI to do our coding. So this is nothing new, right? He said it's new in terms of the awareness from end consumers that are now using it, where you and I, who might have labored over an Excel spreadsheet to get it to do what we want to do, are now figuring out how to use AI to make it work and do it faster. And I've obviously embraced that to some degree, and it's amazing when it works right. And that can save a lot of time. It also can take a lot of time to figure out how to make it work right as well. But the true coders have been using this for a long time, right? So I think it is. I think it's overhyped in terms of what it's going to do. And I think the worst case scenario is that the Citrini research reports that say it's basically the end of civilization as we know it because it's going to replace everybody. I think that's massively overdone. If you think back to the 90s tech bubble, there were headlines all over about the number of jobs that were going to be replaced by technology then, and it didn't happen. We're at an all-time high in the labor market. There will be disruption in the labor market. There's no doubt about that. But what people do is they migrate to where the jobs are going to be. You think through time at technology innovations, and they create jobs that nobody could have imagined. 100 years ago, nobody thought a flight attendant would be a job.
Yeah, right. Good point.
It is, right? And you see this over and over and over again. Automating the assembly lines, and that was going to displace all these workers. It probably did displace some, but we continue to create new jobs in other areas, and I think that's going to continue to be what we see.
So here's my analysis to it. It's just like when spreadsheets first came out, they were same thing. Spreadsheets were going to take over the world. And back in the day, companies had floors of bookkeepers to process everything. That now maybe a handful of people have to do with where technology is, but those people were deployed in other parts of the organization. I think software is not going away. I think the amount of programmers they're going to need is where they're going to probably have the biggest hit. And it's like any business. If I can figure out how to do it with 2 instead of 5, then I'm going to figure out how to do that and make my firm more efficient. So I think that's really the play that we have going forward with AI at this point. I want to get into more of it, but I do need to take a break. Some things on my mind that I want to talk about after the break is the new Fed chair. How handcuffed is he really going to be? And I think a lot. And this was a lot talked about when we were at the Gold Forum, was private credit and private equity. There's a lot of people trying to persuade people like me that that's a good proposition for our clients. And I'll preface it by saying I haven't gotten there yet. So no one's effectively persuaded me yet that that's something I should be doing. So I want you to challenge me on that when we get back. Deal?
Deal.
Okay. This is Leo Daprile. This is the Gem Young Wealthcast. We'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back. Welcome back to the Gem Young Wealthcast. Almost forgot I had a microphone in front of me. I have with me today Glenn Dorsey. We are kicking off our analyst season. We had a good conversation in the first part of the show. We talked a lot about the geopolitics. I know that's current. That's on your mind. And Glenn gave some great insight to that. But I want to go back to some other things. We got a new Fed chair coming in May. This is a Trump appointee. But there's a board of governors that don't make it as autocratic of a decision as maybe President Trump would like. So that's going to be interesting. With the ongoing lawsuits with Jerome Powell, by law, he doesn't have to leave in terms of being a board governor. So he's indicating he may stay around. And I want to get into a little bit about private credit and private equity in your portfolios, because that's becoming a hotter and hotter topic. I've been researching on it, and so far, it sounds great, but I'm not compelled it's the right thing for all people. So I'm going to have Glenn weigh in on some of these things. And like always, I give him all 15 of my thoughts at once. So Glenn, welcome back.
Thank you.
So let's start with the Fed. All right. The incoming governor was a former governor, and his positioning when he was a former governor was a lot more conservative than the rhetoric he's been presenting recently. It's from my research, and my research showed that when he was a Fed governor before, pretty sensible guy. He was a well-respected guy, and now we have a bit of a position change, but even though he can take maybe a more aggressive posture in terms of interest rates and all that, we still have to look at the headwind I see him having is with oil going up and that impact on inflation. I don't think the Fed's raising interest rates, but I think it's going to continue to pause. And I think him having more sway over the rest of the Board of Governors on interest rate reductions is a much bigger challenge than I think he's going to be able to accomplish. And quite frankly, I wouldn't want to be that guy right now with everything that the president wants him to do and what I think he's going to be unable to do. What are your thoughts?
Yeah, I would agree. I don't think I'd ever want that position, to be honest with you. So he was a Fed governor from 2006 to 2011. He was well respected. He tended to be pretty rational in his thoughts. He did not like extreme Fed measures. So, for example, keeping Fed funds rate at zero for a prolonged period of time after the financial crisis. He wasn't a big fan of the massive purchase of treasuries by the Fed to lower rates. So he was more traditional and didn't like the extraordinary measures that the Fed embarked on. So I think you're right. He's got his work cut out for him because the Federal Open Market Committee is 12 people, right? You've got 7 on the board. You have the New York president, that's 8, and then you have 4 rotating regional presidents, right? So 4 people came in at the January meeting, 2 of whom were slightly more hawkish, 1 slightly more dovish, and 1 sort of neutral. So I don't think it's a layup whatsoever that he'll be able to convince people to lower rates more aggressively. The situation with energy prices definitely makes it harder because it's not that necessarily the price that we're paying at the pump, which is what we all feel and we all see. It's the cost of transporting everything, right? And companies are going to want to make that cost back up. It's the input costs that go into manufacturing so many things that it will or should create a little bit more of pressure on the inflation side. So I think what the market has done, we've gone from pricing in 2 cuts in 2026 to less than 1 is being priced in. There's about a 23% chance of a cut by the end of the year being priced into the Fed funds futures market right now. So we've effectively taken out 2 cuts expected out of the market. I still think that when things start to settle down, that the Fed might be in a position where they can start to lower rates towards the end of the year.
So we talked a lot about that Q2, you're expecting more robust earnings, and the earnings projections are justifying that. So if we're going to be having that sort of success, does it warrant, from just a pure economic perspective, does it warrant a rate cut?
I think where you're seeing the potential for a rate cut is that the labor market's definitely softened. Right? You're seeing less job ads, but you're not seeing a pickup in layoffs, right? So it's kind of a no hire, no fire labor market. But I think even Chair Powell, who has not been a fan of cutting rates aggressively, still says that we're kind of at the lower end of restrictive or the higher end of neutral in terms of where Fed funds rates are. So when you look at kind of where GDP growth is and where Fed funds are, we're probably still at the higher end, and I think there is room for the Fed to cut without it being inflationary.
I always look at it and say the reason President Trump's pushing so hard for the cut in interest rates has really more to do with the federal deficit than in anything else.
I don't think there's been a president that's been in office that hasn't been in favor of cutting rates. He tends to be a little more vocal than some of our past presidents. But, it's a multifaceted thing. One, it certainly helps with the deficit. 2, it does stimulate the economy. So if you're a president, you want to preside over an economy that's booming. And 3, it's good for the financial markets. And he does like to quote how many new highs we've had in the S&P 500 and all those things. So it's a win across the board for him to have lower rates.
So there's an old expression that the best thing a CEO can do once he's done with his job is be escorted out of the building, right? And let the new guy have the bandwidth to do what it is they need to do to take a company forward, right? How much of a hindrance to the Fed will it be if Jerome Powell sticks around?
That's a great question. I think if he sticks around, it's more for protection from any litigation that's going on, which, I think is disruptive to the whole process. I think I would prefer that that's not going on right now. So I think he would want to stick around for that protection. I don't think he's necessarily going to be vindictive and say, well, I'm going to keep everybody else from wanting to lower rates. I think he's a pretty reasonable person. It's a job that you take not for the pay, right? The federal employees aren't necessarily the highest paid given how much responsibility they have. It is about, I think, ultimately your legacy, right? So I think he would like to be able to go out on a good note, and hopefully that happens. I don't think keeping the Fed from lowering rates and as the economy's slowing and potentially going into recession, which again is not our forecast, but if that was happening and they didn't lower rates, I don't think he wants to be on board with that.
Right. I think the way I see it is this is his pressure for the lawsuits against him to be dropped and to be enough of a thorn in the side of the incoming Fed chair. So the incoming Fed chair asks for that instead of Powell.
That would probably be a win-win then. There's a lot of negotiating and posturing going on, internationally and domestically. So I think that to have that distraction go away would probably be a positive thing for the market.
Yeah, I would agree. And then that takes, at least for this round, at least the perspective that the Fed has become political. So, All right, let me move on to, because this has also been a big thing this quarter, and it was something that's been talked about for the last year or so, is private equity inclined portfolios and private credit as almost the public bond alternative. And the private credits had a lot of bad press so far this year. And I will admit that so far I'm still a traditionalist from the perspective that I've not put any of my clients in private credit or private equity. And the big thing for it, Glenn, and this is where I keep getting stuck on it, it's still about public disclosure. It's about the quarterly earnings reports that come out so that it's very transparent of what a company's doing. It's freely traded based on their success or failures. And a lot of these private credit situations or private equity situations, they're lockup scenarios. And even when I would talk to these folks, it's not like there's outsized performance to be in these. The argument always is for a client portfolio that it is just additional diversification to non-traditional assets. Okay. I'm still not sold on that. That still wasn't good enough for me because I think there's some other perspective. Like I said, the liquidity of public companies, the quarterly reporting of public companies, and what's going on in the private credit market because the lack of reporting of what's happened in this quarter, in my opinion, it's not that these are bad or fundamentally wrong, but I think lack of information, it's a fear-driven scenario, right? So that's kind of my take on it. Do you want to weigh in on that?
Yeah, I have a lot to say about this too. We've been asked quite a bit over the last couple of years about private credit. So they are billed as alternative asset classes or non-traditional asset classes with a lower correlation to the stock and bond markets, private equity to stocks, private credit to bonds. That's true to some degree, and part of it is because they don't have daily pricing. So, a private equity company is not valued every second like a publicly traded company is, and it's valued on a periodic basis. So you will have a lower correlation because the values aren't necessarily reflective of where it would trade, where the public markets are. I'm not saying that they're bad asset classes, but I think you need to be careful to think that they're not correlated with traditional markets. My opinion on private equity, it is like public equity with a higher beta, right? So meaning that when it's right, it's really right, and when it's wrong, it's really wrong. There's a lot of great private equity firms that have established very good long-term track records. What you also find with private equity is the returns are very dependent upon the vintage year or the years that they start. So funds that started investing because they raised the money and started investing in private equity in 2009, for example, were buying in at bargain prices. Right? Those valuations are not as compelling today, so I think it's reasonable to expect lower returns going forward there than you may have seen historically. On the private credit side, to say it's not correlated with bonds doesn't make any sense because they're bonds, right? They're just not publicly traded. They tend to be lower credit rating, right? So what you've seen is bonds have the high yield index, for example, is the highest quality it's ever been right now because a lot of things that would have been in the high yield index are in the private credit space right now, right? So you have lower credit quality, you have lower liquidity, and we're really starting to see that now. And you don't have the same disclosure, which you identified. I think the problem that exacerbated everything is a lot of retail money flowed into that space. So now you've got tons of money going into an area that's already a little bit on the lower quality side. Now they're trying to find areas to invest it, right? So you're going further and further. The credit seems to be deteriorating. And that's what we were concerned about. That's typically what you see at the tail end of an asset class move is a lot of retail money flowing into a space to chase returns. And now the people were buying things that they didn't understand, and they're seeing the value go down, and they're seeing all the headlines. Now they want their money back, and guess what? They can't have it. Right? In many instances, the companies are saying we can't meet all of the redemptions that we have. And probably to some degree at this point, you might have a little bit of the baby being thrown out with the bathwater, right? There's this rush or run on the bank. We've seen this before where people are concerned they won't get their money back, and then they want their money back. And that creates its own set of problems. So the good news is that we don't think it is something that ripples through the financial markets and has a bigger impact on the high quality banks, but it is very isolated right now in terms of the problems that they're experiencing. So again, we don't believe it's a non-traditional asset. We do believe we value liquidity a lot when we're managing assets, whether it's on the stock or bond side. So, that's an area that we've stayed away from.
So 2 points to that. So I'll go back 20 years ago, when non-traded REITs, non-traded real estate investment trusts, were the hot thing. And at that time, my broker-dealer invited me to a conference, and it was all just non-traded REIT vendors, okay? After 2 days of that, I just couldn't get my arms around that one either. And it just happened because I always say when you go to these conferences, you learn more at the cocktail hour than you did in the 8 hours of sessions, right? So I happened to be there with a trader, a bond trader. We're just at the bar having a drink, and the non-traded REIT guys are doing their thing. And he went into trader mode, kind of beating these guys pretty hard. I was like, ouch, but he was right. So I walked out of there. Naturally, I get the calls when I get back from my broker dealer at the time. What'd you think? I'm like, I can't do it. I can't lock up money that way. So I never did those. And those, as we know, through time have had their own history of problems. We still see, and it's like anything, like the baby in the bathwater analysis. There were some good ones, but a lot weren't. And that was the problem. Right. And same thing in private credit. There's some good ones out there. I'm not going to name names. I was fortunate that I was at a private meeting at Gold Forum with one of the directors of one of the well-respected private, and he was fuming about what these other companies were doing to what should have been a good business. And they were having to battle this. Their stock has been down since then because they're the bathwater. Right? They're the baby going out with the bathwater, right? They're that situation. This all gets back to having an effective, diversified portfolio to begin with, right? And so not that I want to bring this back to the basics, but when you're looking at these other investment alternatives, and they look shiny, right? Because everybody's trying to pretty them up. But what I caution clients on is every one of these private equity deals is different. Unless you spend the time to really get to know these whether it's private equity or private credit, you really better know what you're doing before you get involved in. And sadly, people don't. And after spending a couple of days with these folks, that's what I came away from. These are very unique products, company to company. And make sure if you're going to do it, your eyes are wide open, or just make sure what you have, like in the case of a Clark Capital managed portfolio, we already have the individual securities, right? We're already managing to the risk. You guys are already managing to the asset class. And more importantly, you're managing to the client's tolerance towards risk and the strategies of what they're trying to accomplish.
Yes. So those asset classes became very, very popular in the public space. So the endowments, the foundations, the pension plans, they have these very, very long time horizons, in most cases an infinite time horizon. Liquidity isn't something they need to put a premium on. So they're able to put a decent percentage of their long-term assets into something that's relatively illiquid. Most of our high net worth clients, even though they might not need the money, do put a premium on the ability to access their money, right? They maybe decide they want to buy a vacation house, or they're doing some other major renovation or trip, and they want their money. So it's a different asset class and harder for the high net worth individuals. When we're managing our bond portfolios, we're managing interest rate risk, credit risk, and liquidity risk. Liquidity risk is a big deal. We want to make sure that we're able to get out of a bond if we want to at not a prohibitive price, right? That's a difficult thing to say with an relatively illiquid asset like a private credit.
Yeah. Whoever you came to the party with, you got to stay with, right?
Right.
In that scenario. So anyhow, I wanted to ask you that before, but I'm glad I saved it for today because that's kind of where we're landing on it. And it's like anything, Glenn. it's not that they're bad products. And I say this, and I won't get into this product grouping, but there's a certain insurance product that to its core is a great risk management product, but it's so poorly sold and it's so grossly oversold that it just looks bad for so many people because there's so many people in it that shouldn't be. But like private credit, or private equity, for the right person, the right environment, they make sense. I don't think they're mainstream. I think that's what I want listeners to take away. They're not mainstream products. And no matter the wealth of my clients, to your point, liquidity matters because I always viewed it from the perspective that people are dynamic, so their portfolio should be dynamic. The portfolio should model them and move with them, right? So if we have part of it anchored over here and says, you got to wait 5 years to get to it, that doesn't make a lot of people happy. But to your point, in an endowment situation where they have 50-year commitments, where they can say, we can do this for 10 years because we have so much other liquid assets, there it makes perfect sense. So great for that perspective. Correct. So almost out of time, but just give more predictions of where you think where your crystal ball is for this quarter and where that plays out the rest of this year.
Well, I think importantly, we haven't changed our year-end target for the S&P 500. We're still at 7,700, which is upper teens from where we are with the S&P right now. So that would be a pretty good move. We went through the same thing last year. We set our target. We had the tariff tantrum in April, and we got down nearly 20%, and we didn't change our target. We had a lot of people think that we were being very bold not to change it. But by the end of the year, the market slightly surpassed where we were. So we think it's going to be a similar year this year. As we had said a couple of months ago before the Iran conflict, we expected it to be a bumpier ride. We're not out of the turbulence yet, right? We're still in the middle. We're still in the middle of it, both from an Iran situation, but also from the Fed changing the guard at the Fed, and also it's a midterm election year. So we probably have a few more months of choppiness. That doesn't necessarily mean it's down a lot. It means it's just going to be volatile and choppy. And then, ultimately those earnings should drive the values of those stock prices higher. And that's what we've seen over time is the value of a business is very much determined by how much money it makes. And as long as the earnings continue to trend higher, we think it's a pretty good environment.
And it always gets down to that. At the end of the day, it's just that simple. Right. Glenn, thanks for joining me today. As always, you're awesome. Great insight, and I appreciate the federal government giving us a great topic to chat about today.
Thank you for having me on, Leo.
All right, we'll see you soon. All right. Okay, this is Leo Daprile. This is the Gem Young Wealthcast. We'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or Supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare Supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, Here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. Well, we have week one of our analyst roundtable in the books. It's been a lot to talk about this quarter. There's a lot on your mind. We hear it from our clients. Naturally, the war has been top of mind, and Glenn did a nice job, especially on the conversation we had with oil. So if you didn't hear that conversation, go back, download the podcast. We're available anywhere you get your podcast downloaded, or you can check us out for the video podcast on our YouTube channel. Pretty simple to find out. But there was a lot to unpack in terms of an incoming Fed chair this quarter, what the impact of earnings are, and it was surprising to hear that in the midst of all of this, the noise you're not hearing is that the major indexes are increasing their earnings prospects for companies this quarter. And as Glenn pointed out, it's normally the opposite. Normally they take the month or 6 weeks before the end of the quarter and they begin to reduce their expectations because, which if you're a regular listener, you've heard me say this all the time, that one of the things that makes me crazy in this business is analysts hate to be wrong. So they're always making adjustments a month to 6 weeks before because nobody wants to be wrong on the high side. They'd rather be wrong on the low side. So that's why we start having all these earnings surprises. Back to the point of what we really had going on at the beginning of the year and the reason we had the correction to the degree, number one, a 10% correction in the course of a year is normal. So don't be afraid of that's where we are. We look at this in this business and saying that's just a normal reality of what happens. Volatility is not really that far out of line from what we're used to for people like me that have been around it for a while. Having effective strategies and staying engaged in those strategies is always vital because times like this, and Glenn kind of confirmed what I was already going down that road anyhow, is this is just a lot of headline noise with the war. And I'm talking from an economic perspective, not the human perspective. That's certainly a whole nother conversation. But today, that's what we're talking about is your money and how that impacts your money. So a great show again. Glad to have Glenn on this program as always. He's the head of client portfolio manager at Clark Capital. This is Leo Daprile. This is the Gem Young Wealthcast. And until next time.
Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.